Hi everyone, Alex from Summerhill here, just with another quick market update. There's been increased market volatility again, which is testing the lows that we experienced in June. Market commentators are now talking about a recession. Now, as a reminder, technically a recession is 2 consecutive quarters of negative growth. So why are markets acting so volatile and commentators talking about a recession? It all has to do with inflation and whether central banks will overreact with increasing interest rates too fast in their attempt to combat inflation, which may result in a recession. Initially, central banks assumed that this wave of inflation was transitionary or short-term, related to the consequences for measures taken during the COVID pandemic, but it is now apparent that global inflation is more enduring than first suspected. High inflation means that interest rates are rising faster and higher than originally forecast, and this is causing volatility in equity, property and bond markets. When inflation hits, central banks like the Reserve Bank of Australia and Fed in the US really have one tool, and that's increasing interest rates to curb spending. Rising interest rates may dampen discretionary spending, new cars, new TVs, travel, although it doesn't appear to have so far, but it doesn't do much for non-discretionary items like petrol, food, etc. Central banks around the world, including the RBA, are now in a situation where they have to engineer a slowdown in demand to contain inflation while trying not to push their economies into a recession. But it does appear they are willing to put their economies into a recession in their goal to manage inflation in this instance. While I can understand why central banks are so hell-bent on slowing rising prices, I mean, nobody likes to see sky-high inflation, but in other ways, some believe they have overcorrected and are treading a dangerous path given the significant increase to rates in such a short period of time. I mean, the stock market is pulling back, petrol prices are reducing, commodity prices are down, freight rates and container costs are declining, as well as fruit and vegetable prices. So many, myself included, don't understand why central banks are not giving it some time just to see how things play out from here. The central bank's forecasting ability leaves a lot to be desired. It wasn't too long ago in 2020 where the Fed and the RBA were predicting interest rates wouldn't increase until 2023-24, only to then see one of the sharpest short-term increases in rates in history. But the good news, I guess, is that they are consistently changing their mind because they are just as bad at predicting the future as everybody else. So, how should we be thinking and how should we handle the current environment? The current market volatility has a lot of investors spooked at the moment, but uncertainty and unknowns about the future aren't going away anytime soon. So it's important to switch your mindset from dealing with volatility to living with it and to embrace change rather than fight it. We are not in the business of making predictions, and of course it will be impossible to answer what will shares, property and bonds do in the next 12 months without a crystal ball. There are simply too many unknown unknowns. We don't know what will happen in the next 12 months or how that will impact the performance of assets. However, there is some evidence from looking into history that we can use to see how stocks and bonds may play out from here. What we do know is prices are down for financial assets, but expected returns are rising. You can finally earn some yield on your cash and defensive investments. Now, if interest rate increases continue to be higher than expected, it will cause further volatility. If interest rates don't increase higher than expected, it may result as being a positive for share and property investments. When it comes to shares, predicting the short-term path is impossible. Markets are consistently changing and evolving over time. In some ways, it's different with every bear market. A bear market is a market pullback of more than 20%, as what we're seeing over in the US. But in other ways, it's the same every time, especially when it comes to human nature, which is the one constant throughout history. We cannot say whether stocks have bottomed out or whether there is more volatility to come, but we do know that on average, markets recover very quickly from a downturn. Are we headed into a recession? That is a possible outcome from the current path of cash rate increases. But there are several key takeouts from historical performance of stocks during recessions. Recessions have been relatively short-lived compared to most investors' time horizons. The length of the last 7 recessions in the US varied from just 2 months in 2020 to 18 months during the 2008 global financial crisis. Of course, those recent experiences do not preclude a longer recession, but the official declarations of recessions are backward-looking. A recession can end before it's even been declared. And stock markets are forward-looking. Investors wondering if we're heading into a recession and whether they should adjust their portfolios should consider history. And markets tend to fall in advance of recessions, with the prospect of a recession already starting to be priced in by many as an outcome. And stock markets tend to rebound during recessions. So even if we know for sure the economy is headed for a recession, and we don't know that for sure, it does not mean stocks will be negative in a negative growth period. What we do know is that over the long run, bonds and stocks are modestly correlated. In other words, most times, both asset classes have positive returns on an annual basis. Stocks have a negative annual returns of an average of once every 4 years, while it is less common for bonds to have an annual negative return. It is rare when both stocks and bonds are both negative in the same year, as what has been the case this year so far, but it has happened before. The last time this happened was in 1994. Of course, that can happen again, but keep in mind that in 1995, bonds were up over 18% and stocks were up just over 21%. I'm not saying that's what we should expect for returns over the next 12 months, but it does highlight the risk associated with moving out of certain asset classes in the short term as a result of fear or based on predictions from commentators regarding the risk of a recession. We haven't seen this sort of volatility in markets since March 2020, when markets fell by more than 30%. However, markets had pretty much recovered over that next month in that year, and by the end of that year, all major markets were showing positive returns. So that's just another example of the risk of making large changes to your investments and strategies based on fear. So, what are the survival strategies that we can use to get through the current market uncertainty? Stick with a long-term investing strategy no matter what the market or the economy may do. Every bear market causes feelings of panic and despair. They may make you question your previously held investing beliefs. Since the start of the year, Australian market is down nearly 16%, not taking into account dividends. The US market is now down a little more than 20%, and the Nasdaq, the tech-heavy stock market, is down more than 30%. Stocks are now looking more attractive with higher expected future returns than earlier in the year. They could get marked down even further, but I don't think too many people are going to regret buying stocks right now when they look back in 10 years' time. Conversely, if living off your investments to meet your living needs, many may regret selling shares now if they look back in 5 or 10 years' time. Investment markets are driven by more than just fundamentals. Investor psychology plays a huge role and helps explain why assets go through periods of booms and busts. Numerous studies by psychologists have shown that, apart from you and me, of course, people are not always rational and tend to suffer from various lapses of logic. And this is only magnified by crowd psychology and the pressure for conformity. There is nothing you can do to control the future and market volatility, but you can control how you react to volatility. We believe that staying invested in a portfolio that is designed for you puts you in the best position to capture the recovery. The only good reason to change your portfolio now is because you learned something new about your risk tolerance, or your investment goals and personal circumstances have changed considerably. During market volatility, you can either do something, anything, or you can do nothing. And in volatile times, it's generally best to do nothing and accept that volatility is a part of investing, and bear markets don't tend to last very long. So just recapping a couple of points we've made in the past in previous videos. Tune out the noise from the financial media. The financial media is full of fact and fiction. The facts are straight reporting on what happened in the market yesterday, company earnings, acquisitions and mergers, and policy announcements. Fiction is everything else, the views on what will happen tomorrow. That's just noise and designed to scare and confuse people. Remember that markets are unpredictable and rarely do what experts predict they will in the short term. And also remember that for every seller of a stock, there is a buyer. The media headlines might proclaim that investors are dumping stocks, but remember that someone is buying them. And for everyone that sells the stocks because they view it will go down, there's another investor who believes that the stock is now trading at a fair price and that it's a good time to buy. And those people are often long-term investors. Try not to time the market. Recoveries can come just as quickly as the prior correction. And the lesson is that reacting impulsively to daily market movements is almost always counterproductive. And finally, diversification is crucial. Diversification that we implement in client portfolios spreads risks and can help moderate the volatility in the portfolio. We're not sure how long the current market environment will last. We don't know. What we know is, though, paying more attention to the stock market when it's in a downtrend is not going to make your life as an investor any easier. What matters is whether you're on track to meet your long-term goals detailed in your financial plan designed for you. So that's it from us today. I do apologise this video went on for a bit longer than usual, but I felt it was important to cover off on these matters. As always, we appreciate your feedback on content you'd like to see in future videos.